A lot of investors tend to think that returns get split evenly, but that's not actually the case. There's actually an entire structure behind it called a waterfall that determines who gets paid what and when. And that's what we're going to talk about on the Furlo Capital Real Estate Podcast, where we dive into the intricacies like this of passive real estate investing. And our goal, our mission, is to equip investors to invest wisely in both properties and people's, fully understanding their returns so that together we can build wealth while improving housing. I'm James, and this is my wife, Jessie.
Speaking of water, that was great. We're going to talk about waterfalls, but
I'm not going to chase them. We're going to talk about them.
I'm not chasing them. Yeah, I have water on the brain because I'm...
Okay, because you have to go to the bathroom?
No.
Okay.
It's because I'm redoing some of the watering systems in our front yard.
Okay.
And there was an interesting problem where a pipe kind of broke, and we asked an expert.
Yeah.
Thanks, Dad.
By the way, happy birthday. Today's his birthday.
Oh, happy birthday, Dad. Yeah, he had a brilliant solution that was like, I never would have thought of that, of how to get the pipe out of the other pipe and
how to get a pipe that's broken off
right,
inside
it's
out.
broken off and the side, you know.
If you want to know, leave us a comment. We'll tell you how.
This is unrelated, but water, you know, all the little nuances of how pipes fit together and how the water is like, you never know after a season, you turn the water on and it sprays out in random spots and you're like, oh.
Yeah, and that can often feel like investing, right? Like you invest and then time goes by a lot later, and you never know. All of a sudden, like money starts coming out, and you're going, "Hold on a second, is this where I thought the funds were going, or not? This is not what I was expecting." And you have questions, so it can be unexpected. Yeah. And so our goal in this discussion is to help kind of clarify that.
All right.
So this is
interesting.
A little bit technical, but I think if I do it right, you're gonna go, "Oh my gosh, I totally understand how this works." And I have an amazing analogy. Amazing.
Is it a waterfall?
To start this out, no, it's not.
Oh.
So the first question that you have to ask is, what is the capital stack?
Oh, wait, we talked about this.
Yeah, do you remember?
This is like a pop quiz.
Yeah.
Okay, the capital stack was...
stack of capital.
So
capital, another word for capital is money.
Yes, and like it's like pancakes. We talked about pancakes.
Yeah, we talked about flipping pancakes.
Yeah,
but essentially it's... where is the money coming from to fund a deal?
Okay.
That's the capital stack.
Like the order of investors. Well, it's not really order. I guess it's just the chunks of investors, where it's coming from.
Yeah. Okay. Where's the money coming from? Might be from a loan, might be from a bunch of other places. We're going to talk about that. Mm-hmm. So here's what I want you to imagine. Imagine a high rise, okay?
Yes.
High rise building. And each floor represents a layer in that capital stack. Okay? So on the lower floors, you have senior debt. Think mortgages, okay? Those get out first in the case of an emergency, okay?
What do you mean by get out?
Like if you, I don't know, if you went bankrupt and you had to get rid of the property, banks get paid first.
They get paid first.
The loans get paid first.
Or so like in a building, in an emergency, they're on the bottom floor.
Yeah. Something bad happens, got to get the capital out.
Yes,
they get their money first. Mm-hmm. Whereas those in the penthouse level, often called common equity, they get the best view. In other words, they might get the best return, but they also take on more risk.
Right, because they got to go all the way down to the bottom.
Yes, whereas a mortgage is super boring, right? It's a fixed interest rate.
Sure.
There's nothing interesting there.
Not fancy.
So there's essentially there's 4 different types of debt. You have, like I said, that senior debt. Think bank loans. They're your lowest risk, lowest return, and they get paid first.
Yeah.
You then sometimes have what's called mezzanine debt, which is it's kind of an in between. It's like a bridge debt sometimes, where it's a little bit higher interest. So like, let's say you want to, like a construction loan is oftentimes that kind of debt, where you're going to do a bunch of work and it's kind of more short term. Hey, you can have this for 2 or 3 years. Maybe the interest rate floats, but we're helping you get by.
Interesting.
And helping you do whatever the project is that you're trying to get done. Mm-hmm. And then you have what's called preferred equity. Okay, so now this is equity. So it's actually investors who own part of the property, but they get a fixed return on their money. Okay. And then the final step, the final group of people to get paid, and this is all going in order, is what they call common equity. Yeah. Okay, and these are just your normal investors. The sponsor and the passive investors are typically that, and they get what's left, but also potentially get the highest upside. Because it's like, if you think about, I don't know, we'll make up some numbers. If you have $100 return, it's like, the bank is going to get $20. Maybe you have some mezzanine debt, they get $5. The common equity might get $20, and then we had like 65, and then the equity gets the other 65. But I don't know, maybe instead of getting $100 back, you're only going to get $75 back, right? So that's kind of where that risk comes in.
Interesting.
To it. Yeah, yeah.
And so some of those levels are fixed amounts and some of them are percentages, but the waterfall effect.
Well, they're all percentages, but some of them are fixed percentage and some of them are percentage based on.
Oh, okay. It's all percentage of your profit, but.
Yeah. So does that make sense? Like a capital stack.
So.
And so as a general rule, the higher you are on the stack, the more risk, but the potential for a higher return.
Sure.
Okay.
Is it also like, I mean, really, the way that you described that, the first three in that capital stack were kind of passive investors. They weren't necessarily doing work.
All of them are, yeah.
But at that top level, you were saying it was the sponsor.
The sponsor's often included in that, yeah.
Okay.
Yeah. But
which
no,
they're doing more work. You know, if you think about like they're putting the deal together and they're...
No, I don't think of it that way. Think of it more of that has nothing to do with it, right?
Oh.
Because like a sponsor, if they're doing the work, they actually get paid a fee to do the work. So,
which is separate from that.
Yeah, that's totally separate.
This is just the payouts,
just the
from
ownership. Yep.
Profits. Okay. All right.
Yeah, and it's just saying I'm willing to take my money last. I'll take
Sure.
whatever's left over. Could be risky, but it could also be awesome.
It makes sense.
Yeah. And like I said, there's pluses and minuses to all of them. So that's the foundation for understanding what a waterfall is. Okay, so a waterfall is the structure that outlines how the cash from operations or a sale, they flow down to the different parties.
Okay.
And these are often called tiers. So we're going to start with a very simple waterfall structure, the thing that I actually teased at the very beginning, which is you might have something where the profits are split evenly, where it's like, yep, the sponsor gets, I don't know, 30%, all investors get 70%, we split all of it. And maybe that's because you paid cash for the entire building. There's no loan, there's nothing. It's just, hey, we bought this.
So in the capital stack, you would just have two.
Just one. Well, no, it's just one tier, just one.
Oh.
I guess, no, just one. It's just investors put in money in. That's it. It's just all common equity. And you're saying, yep, we're going to split it between, and this common equity, that piece of it, that tier, that whatever, we're just going to split it however we do. 30-70, 80-20, 50-50,
so
whatever.
You're right. This is getting into like the subtleties and the nuances because I'm kind of like,
we'll get more complicated.
Well, what's the difference between a loan then and investor money? Isn't that just a loan?
No, it depends, right? So sometimes investors can give you a loan and they can act more like that senior debt where they have a fixed interest rate and they do get paid first. So that is definitely a thing.
So it depends on the terms that you agree upon when people give you money.
Yeah. But common equity is like, it's not a loan. They have ownership of the property. Okay, we're going to look at a more complicated example, okay?
Oh boy, here we go.
So again, like this is waterfall. So from a waterfall perspective, banks and the senior debt always gets paid first, right? Then the common equity happens. So maybe you have one where it's like you have a tier one, this is your first tier, where it could be what you do is you first say, we're going to do a return of capital. So everyone who put their money in, they get their original investment back first.
Okay.
So whatever cash flow, whatever sale happens, like we give you your money back first, proportional to how much you put in.
Okay.
Okay. Or you could have what we call a preferred return based on, say, like an IRR. So some percentage, right? You might say, we're going to pay back our investors 8% first. And they will get 100% of the profits until they hit that 8% preferred return.
Okay.
Okay.
Yeah.
Which is very similar to preferred equity in that regards, but that's just a piece of it.
Sure.
And then what you potentially have, and also like in this, like a tier 1.5, I guess, I don't know, is you could have this optional catch-up provision where once all the investors hit maybe that 8%, the sponsor then gets to catch up to also hit an 8%.
So you're not waiting necessarily till the very, very end.
Right. So you might be like, we're getting all the water's flowing to the investors until they hit their 8%, and then the water's going to flow until the sponsor hits their 8%. And then you might hit a tier 2 where instead of it being 100%, you go, well, the profits are going to be split. Like let's say 70-30, 70% to the investors, 30% to the sponsor. And we're going to do that until we hit a 15% IRR.
Mm-hmm.
Okay, so now they've hit a 15% return. They feel good about it. And then, and they're going to get there faster because they're doing a 70% and the sponsors, whatever it is. Once you hit that, you maybe have a tier 3 where maybe it's a 50-50 because they've already hit their 15% and now half of it goes, and now the sponsors overperformed essentially.
Sure.
Because usually the end of that tier 2 is defined at whatever they put in the underwriting. Hey, we think you'll get 14%. We think you'll get 15%.
Okay.
Whatever. And so we hit those metrics. Yay. Now means a sponsor for overperforming, I get a bigger proportion of it. Could be 50-50. And in theory, you can have a ton of tiers if you really wanted to get crazy. Like you could have a dozen, you could have 20 of them, potentially where it's like, hey, for each percentage, we switch for each IRR hurdle, we switch a little bit how gradually shifts over to the sponsor.
And you agree on all of that ahead of time. So when someone's giving you their money, they know how the payout's going to happen.
Correct. Yes. And that's part of the point is you need to ask about it. You need to understand how that works. Okay. And it's often written out in a little legalese.
Right.
They might have like a 1 or 2 liner bullet point. I actually put graphics in my stuff so people.
That's what I was just about to say was like, can't you do like a graphic that shows you like the order and the percentages? I feel like that would be really helpful.
But the trick is too, you got to make sure that what's written in your PPM, which is like the legal document putting together the partnership, that what is verbally described matches whatever they showed. Because at the end of the day, it's the verbal legal description is the thing that matters.
That's what they're going to enact.
Yeah. So one of the goals of doing a more complicated version is it gets the sponsors their money sooner. But then it tries to balance it out with if the sponsor does really well, or it gets the investors their money sooner. And if the sponsor invests well, they get more of that upside. Again, they're last one to get the money, so they potentially
they should get a slightly higher return.
Potentially, yes.
Or that's one way it could be structured.
Yeah, exactly. So I got some questions as a passive investor that you can ask a sponsor. Yeah. I got 5 of them. First one, just simply like, so where am I in this capital stack, right?
Yeah.
And especially like, because when we do flips, they're a lot lower on that capital stack because they are getting a fixed return back.
Okay.
Right? They're not sharing any upside.
They're acting more like a bank.
Yes, correct. And it's just good to know that. They don't get any of the upside, but they get a guaranteed percentage return.
Sure.
So,
which some investors, that might be their priority.
100%.
So,
yep. They might ask, what's the preferred return? And is it cumulative? The cumulative is really important.
Like, okay, give me an example of it is or it isn't.
So, so that preferred return, right? It's that like that 9% or 8% IRR. Maybe in year 1, you don't actually make enough money to be able to pay out a full 8%.
Oh.
Maybe so you only hit like a 5%
a fraction
IRR.
of it. And then over time, you make up the difference. But they're only going to get 8% total over time. Is that how that works?
Well, so IRR takes into account time, right? And so if you, it's worse, or how do I'm trying to figure out a succinct way to say this. It's not just like, hey, whatever, if you put in $100, you got to make your $8 back, right? That's, and you just say every year, like I owe you $8, $8, right? Because your base is that 100.
Yeah.
Right. Well, the IRR is a little bit different because in order for you to, in year 1, yes, I just have to give you $8. But in year 10, it's like $12 to hit an 8% IRR.
Ew.
Because there's a time value of money component to it.
So it's not based on what you put in, it's based on what the property makes.
Well,
why would that number be different?
It's all about, so the IRR isn't just a straight return on investment, right? It's the longer you wait, the lower the IRR goes.
Oh.
So if you're going to keep the IRR the same, you have to give them more money. It's not just a straight percentage. And so the cumulative piece is saying, well, over the entire hold period, it's got to be 8%. So if I don't hit it at the beginning, then that means I have to make up for even more of it at the end because it's cumulative. Or you just go, no, it's just 8%, which they wouldn't actually say IRR at that point. They would just say 8% return on investment. They say 8% every year, and it's not cumulative. If they say it's an 8% IRR, it's cumulative is implied. It like mathematically it has to be. That's how that works.
Okay.
And it gets really bad if, say, potentially you could set it up where if I don't pay the full amount, let's go with that $8, maybe I can only do $4. In theory, that $4 now gets put into the $100 bucket. And so now it's like the next year is now $104.
Or it gets reinvested.
Well,
kind of.
It's just saying I owe it to you, and I owe you interest on what I owe you. That's how it could potentially, like, if they don't hit their numbers, skyrocket really quick.
Huh.
Yeah.
So let's just say I'm an investor and I'm not great at math.
Okay, fair enough.
And that's really complicated.
Yeah.
Do sponsors, like, if I'm like, is it standard practice for me to say, I want to invest this much, how much will I get back? Just tell me the numbers. Don't tell me the math. Don't tell me the payout structure. Don't tell me the capital stack.
Yeah.
Just, if I invest it here and you pay me here, how much am I going to get?
Yeah, I actually, in my spreadsheets, I built a little thing out so I can do that exact math.
Okay.
And usually I'll give an example. Hey, if you invest $50,000, you'll get X. If you invest $100,000, you'll get this. And I'll even show it every single year. Here's the estimate that you'll get back.
Okay. I feel like for most people, that's how their brain works. It's just, what am I putting in? What am I getting out?
Yes, but you do want to know what the structure is that's driving those numbers.
Some people might want to know.
You might want to know. That's fair.
Yes, you probably should know how that's working.
Another question you want to ask is there that catch-up provision or not? I tend to not put it in personally.
You just are going to do
I'll just do a preferred equity return, and then we, until we hit that, whatever that is, 100% to them,
right?
To whoever's 100% to all equity owners, which oftentimes the sponsor has money in themselves, and so they're
grouped
getting
into
money
that
as well as and then after you hit that, it goes to a split until you hit 15%, and then it splits to 50-50 for the most part, unless it's designed to be a super long-term hold and like we're primarily going off of cash flow.
Okay,
then I will do actually the really simple version. Go, nope, we're just splitting it 70-30, 80-20, whatever that is. Just because otherwise you never hit the preferred return metric. And it's just like, well, great, me as a sponsor, I'm not getting anything.
Right.
So you want to try to find that balance.
Okay.
Another question, at what point does the sponsor start earning profits? And that's kind of related to that question. Because especially if you're doing that more complicated tier structure, they might be like, whoa, I don't actually earn anything for like 6 years until we sell the building, right? Like, and you as an investor might be like, awesome. But you might also be like, whoa, like, that's weird. Like, will the sponsor then do something to try to accelerate that timeline? Will they make some short-term decisions to get something paid back?
Interesting.
Quicker?
Yeah.
Again, it's all about trying to find that balance, right? And then lastly, you like this question, can I see an example waterfall with real numbers? Yeah, like I said, I built it into my spreadsheet so I can show it. And I often have it on when I'm sharing a property, I'm like, hey, $50,000 invested gets you. This is what
that's just, it's super helpful
to
have concrete examples, you know, so people can put themselves into it.
Yeah, exactly. All right, so I want to recap this. So a capital stack is who gets paid and in what order. And a waterfall is how the profits will get split for that last group. Okay? So that's just the next time you see an investment opportunity, you want to ask to see that capital stack and waterfall structure before committing.
All right. There you go. That was highly detailed, but helpful.
Yeah. I think it's I think it's just one of those, it's such a simple word. And
I kept in my head trying to envision a waterfall and the payout. And it's almost like like a waterfall isn't a correct flow of water in my brain. It's almost like it's a fountain. And so it like bubbles up the top and fills up the little cup. And then once that cup's filled up, then it fills up the other little cup. But it's like an upside down fountain.
Yeah, I guess.
I don't know. I overthought it. And I really had to focus to stop thinking about the water.
No, think of it more like one of those where it's got like a bunch of different cups and the waters just slowly start going here, and then it fills into another one, and then it fills into this one. And you know, and is it a small spigot or a big spigot? And that kind of determines the speed at which things move.
Yes, okay.
That's a better way to think
helpful.
about it. Yeah. So there you go. Those are waterfalls.
Mm-hmm.
And in some ways, you probably should chase them. That's like the one line I know from the song. So I'm just going to repeat that over and over.
Do go chasing waterfalls.
Yeah. Do chase after them. Find good ones that are well balanced, right? That's the key, well balanced. Don't try to find one where if a sponsor is really skewing it to be in your favor, like you might have to ask, like that usually means the deal's not great and they're tweaking some dials to make it seem great. And then on the other end, if it's like, wow, it really seems like this isn't like, I'm still making good returns, but the waterfall's not in my favor at all. Like, okay, that's another weird, like, you got to check out for that. So hopefully down the middle.
All right.
There you go. All right. That was short but sweet. I don't know. I didn't actually time this. Talking about waterfalls. So if you enjoyed that, thank you. Would love to hear about that. Leave a comment wherever it is that you listen to podcasts. And if you would like to learn more about us and how we treat waterfalls and our investing thesis, you can check us out online at furlo.com. Thanks for listening and have a great day.